The White House just changed crypto forever. Hours ago, a tentative agreement on landmark legislation. This is not speculation. This is regulatory clarity finally coming to cryptocurrency. And if you understand what happens when industries move from the shadows into the light, you know exactly why this matters for Bitcoin at $70,000. Let me break down what just happened and why institutional money is watching this moment closer than any price chart. The White House Crypto Summit was not another photo opportunity. It was senators from both parties, industry leaders, banking representatives, and regulators in the same room with a specific goal: create a comprehensive framework that both traditional finance and crypto innovation can operate under. The breakthrough summary: everyone gets something. Banks get the oversight they demanded, crypto firms get the legitimacy they needed, and investors get the predictability that institutions require before deploying capital at scale. Here is what 16 months of deadlock produced. Crypto firms will operate under a defined regulatory structure with clear compliance requirements. Banks can custody digital assets with proper safeguards. Stablecoin issuers face reserve requirements and auditing standards. And perhaps most importantly, the legal status of cryptocurrencies gets clarified at the federal level for the first time. This is not draft legislation. This is a negotiated compromise that has bipartisan support in principle. And in Washington, that means it is go time. Let us go deeper into what this agreement actually contains, because the headlines do not capture the mechanics that will change how you trade. Key Provision 1. Digital Asset Classification. The framework creates three categories of crypto assets: commodities, securities, and payment tokens. Bitcoin is clearly a commodity under this framework. Ethereum likely falls into the same category, but the real impact is on everything else. Tokens now have regulatory signposts that determine which agency has jurisdiction and what compliance requirements apply. Key Provision 2. Banking integration. Banks have been terrified of crypto exposure because regulators provided no clear guidance on custody, capital requirements, or liability. This agreement changes that. Banks can now offer crypto custody with defined safeguards, can hold crypto assets on their balance sheets with appropriate risk weighting, and can integrate blockchain settlement into their systems without fear of regulatory action. Key Provision 3. Stablecoin oversight. This is where traditional finance gets involved. Stablecoin issuers face reserve requirements that look like money market fund rules: one-to-one backing, regular audits, transparency requirements. For DeFi, this is standardized liquidity. For traditional finance, this is confidence. Key Provision 4. Enforcement harmonization. Right now, the SEC, CFTC, Treasury, and state regulators all claim authority over crypto. This creates confusion, compliance costs, and legal risk. The agreement